Hey guys, Rafi here from the Endgame Investor. 2 days ago, we had a preview of what is going to happen in the gold and silver markets once the dollar collapses. We had a reflection of pretty much exactly what's going to happen in the copper market on the London Metals Exchange. I'm going to show you exactly what happened 2 days ago. People talk about potential defaults on the Comex and force majeure and futures not being delivered. This is exactly what happened on the London Metals Exchange 2 days ago with copper. And here I will show you exactly what I'm talking about. Here we have an article titled London Metal Exchange Intervenes to Calm the Copper Market. Calm, it's a little bit too worked up, stressed out, this copper market. Needs some calming, needs some drugs. Wednesday, October 20th, 9:43 a.m. The London Metal Exchange stepped in to try to restore order to the copper market, launching an inquiry into recent trading and announcing emergency changes to its rules. Emergency changes to its rules. If rules can be changed in emergency, they're not rules. Before we get into the article, here is the chart of what happened here, and then I'll read some select paragraphs. You see here 2 lines. The white line is the amount of copper stocks at the London Metal Exchange. You see here in August, it was close to 250,000 tons, 0.25 million tons here. And since August, supplies have dwindled and fallen to near zero. This is the lowest since 1974. Here is the blue line. The blue line is the spread between the spot price, the price for copper for delivery immediately, and the price of copper for delivery in 3 months. As you can see, as the physical copper stocks at the London Metal Exchange fell near zero, the spread between spot copper and 3-month copper rose to above $1,000 a ton, which means the price for delivery of copper now is $1,000 more expensive than the price for delivery of copper in the future, 3 months into the future. This is a squeeze, a physical squeeze on the London Metal Exchange. Copper is not a money. It can be used as a money, but it is not primarily money. It is primarily an industrial commodity. When this happens in money, that means the dollar is done. Here's a key paragraph, or a key sentence really. That came shortly after the exchange announced a set of rule changes that included limits on the nearest term copper spreads and allowances for holders of some short positions to avoid delivery, which means that some people who were long futures who requested delivery could not get it and had to settle in cash, which is exactly what Comex watchers are saying is going to happen with gold and silver once there is a run on the Comex, and that is true. That is almost certainly going to happen. Here, the new measures, meaning the cheating, came after the drop in inventories on the LME drove the spread between spot and futures contracts to record highs in a condition known as backwardation. That's a hallmark feature of a supply squeeze. I've been talking about backwardation on this channel many times. On Friday, LME copper contracts expiring in 1 business day's time traded at a $175 premium to those maturing a day later, smashing previous records and data going back to 1998, while the spread between spot and 3-month futures contracts also reached a record $1,103.50. There was a big run. As a last resort, any companies with a short position who aren't able to deliver metal against it or buy their position back at the capped backwardation rate may have their positions rolled forward forcibly by the exchange. Meaning if they can't deliver the metal and they can't buy back their contracts at the limit because the exchange is putting on a limit for how expensive spot copper can become because they're putting a limit on the backwardation, then they can't even settle in cash. So their positions are going to be forced forward. Meaning, okay, this cannot be settled because we have new rules. And the reason the squeeze is happening is that the actors or banks or whoever has sold short these contracts don't have the copper to back it up. So they're trying to buy back their position so they can close it without delivering the copper, which is pushing the spot price higher and higher and higher. And that is making the backwardation go to almost infinity, or to $1,103, and it keeps going higher until till the exchange puts this limit on the backwardation, which means they can't even settle in cash anymore, and they just get pushed forward, rolled forward by force. And so it's not even a market. It's just a dictatorship. Here's a follow-up article from yesterday on that situation. The title, "What Happens If the World's Key Metal Exchange Has No Metal?" Good question. Gold and silver bugs have been asking that for a very long time. Now we know what happens in the copper market, at least. What happens when the London Metal Exchange runs out of metal? That's the question the exchange is urgently trying to address for its flagship copper contract, which sets the global price for one of the world's most important commodities. So there was one firm that was implicated in a lot of this activity called Trafigura. It says here, trading house Trafigura Group withdrew a significant portion of the copper that's been pulled from LME warehouses in recent months, Bloomberg reported on Tuesday. This is interesting. Trafigura responded by saying it had taken LME stocks to deliver to end users, emphasizing their strong copper demand that is outstripping available supply. Trafigura's role is to ensure security of supply of commodities for its customers, a spokesperson for the trading house said. I find that paragraph about Trafigura saying that it's delivering to end users to be particularly important, relevant, significant. Don't know if they're telling the truth. Maybe they are, maybe they aren't. Assuming they are, assuming Trafigura is telling the truth, and the reason that it was paying these insane premiums for spot copper for immediate delivery, why it was withdrawing all the copper, if it was because it's delivering to end users, this is what a run on gold and silver is going to look like. It's going to look like supply being drained from Comex and the price going vertical, deeply backwardated, and that is when the entire banking system goes kaput as we know it. What happens the next day? I don't want to get into it. How it should work, if things were honest, is that those that are short should be forced to provide metal anywhere they can acquire it at whatever price. And if it bankrupts them, then so be it.
Margin call, gentlemen. Oh, you can't expect us to...
You know the rules of the exchange, Mr. Duke. All accounts to be settled at the end of the day's trading, without exception.
Put the Duke brothers' seats on the exchange up for sale at once. Seize all assets of Duke and Duke commodities brokers, as well as all personal holdings of Randolph and Mortimer Duke.
Turn those machines back on! Turn those machines back on!
If that were to happen in gold and silver, then obviously the bullion banks who hold the swaps, who own most of the shorts on the gold and silver futures exchanges, would go bankrupt. And so would the entire banking system. So yes, obviously, when there's a squeeze on the dollar, gold and silver futures are not going to do anybody any good. If you want to use gold and silver futures for delivery, you got to do it now, when there's still gold and silver on the exchanges. So we've hit the bronze metal. The next metal to go into backwardation will probably be silver because it is also semi-industrial. Gold is very minimally industrial and is almost all monetary. When gold goes into backwardation, the fiat monetary system is dead. Waiting for that day. This is Rafi of the Endgame Investor. You can sign up for a 2-week free trial of the Endgame Investor at the link below, or you can donate to my Patreon page, which is just coming online now. And I have other ways to support me down in the description. Take a look. Everyone have a good weekend. Good Shabbos. Shabbat Shalom. And I'll see you next week.